Imagine the planet's most critical energy artery suddenly clamped shut. The immediate casualty is the stability of the global economy and the US dollar itself. Over a single weekend in March 2026, Israel launched coordinated military strikes against roughly 30 Iranian fuel depots. In response, Iran appointed hardliner Mojtaba Khamenei as its new supreme leader. This move signaled that the regime was prepared for a prolonged physical conflict. The geographic center of this panic is the Strait of Hormuz. Following the escalation, this waterway halted, forcing tankers to rapidly reroute. This visualization shows the scale of trapped supply. 27% of global seaborne crude oil and 20% of the world's liquefied natural gas, or LNG, natural gas cooled to a liquid state for easier shipping, must pass through this specific choke point. Cutting off that volume of energy creates an immediate global inflation shock. As traders logged on for the Monday morning session, the stage was set for a historic, catastrophic market crash. At the Monday open, commodities markets shifted violently. Brent crude, a major global classification of oil that serves as a benchmark for prices worldwide, spiked to nearly $120 a barrel on fears of severe supply shortages. The panic hit Wall Street directly. The Dow Jones Industrial Average dropped roughly 600 points the second the opening bell rang. The ripples hit dependent supply chains instantly. Prices surged for alternative energy sources like natural gas and essential agricultural inputs like fertilizers, which rely heavily on Middle Eastern supply. Investors pulled capital out of equities at top speed, pouring money into traditional safe haven assets like gold and silver to protect against the volatility. Global trade faced an immediate logistical tax. Ocean freight rates skyrocketed as ships were forced into longer routes to bypass the conflict zone, dragging insurance premiums up with them. By midday Monday, these compounding metrics pointed toward a shift that felt permanent. The financial system appeared to be fracturing in response to the blockade. Then, the global panic stopped. The market experienced a sharp intraday whiplash. This chart tracks the reversal. The major stock indices executed a sharp V-shaped recovery. The Dow erased its 600-point loss, and the tech-heavy Nasdaq actually closed the day up 1.38%. The energy panic simultaneously deflated. Crude oil prices slipped rapidly back down to $105 per barrel as tensions began to ease. This cooldown followed an aggressive move by the U.S. Treasury Department, which issued a series of rapid policy signals. Treasury Secretary Scott Bessent floated a specific maneuver. The U.S. might unsanction Iranian oil, currently sitting on storage vessels. This threat signaled a potential influx of new supply, which helped drive down rising prices. Institutional investors recognized the underlying financial logic. They rely on historical data, which indicates that sudden geopolitical conflicts rarely result in permanent market destruction. This Pathstone table outlines equity market sell-offs around major geopolitical events. Looking at the time to recover column, conflict sell-offs are historically short-lived. The average recovery time is consistently fast. This data, combined with physical supply interventions, recalibrated the crisis into a temporary volatility event. The long-term energy outlook remains tense. Major institutions like Goldman Sachs continue to flag upside risks for oil prices heading into 2027 if the conflict in the Middle East evolves further. Domestically, the Federal Reserve is actively monitoring the situation. They watch the region for signs of persistent, broadening inflation that could impact the U.S. economy. Yet, despite these localized risks, the core foundations of global growth and monetary policy remain stable. The March 2026 crash proved an old Wall Street operating principle. There's a common adage that investors should buy at the sound of cannons and sell at the sound of trumpets. Mastering financial history and the mechanics of U.S. dollar policy allows investors to distance themselves from global panic. This perspective reframes extreme volatility as an expected market occurrence, distinct from a total systemic collapse. Imagine a scenario where the entire United States economy and the purchasing power of the dollar itself could be brought to its knees by a traffic jam in a single, narrow waterway. In March 2026, coordinated military strikes by the US and Israel hit roughly 30 Iranian fuel depots. In the immediate aftermath, Iran appointed hardliner Mojtaba Khamenei as its new supreme leader. This action signaled to the world that the regime was digging in for a prolonged, bitter conflict. The regime responded by effectively closing the Strait of Hormuz, instantly freezing global energy transit. This map shows the Strait of Hormuz and the energy resources that flow through it. By shutting down this geographic choke point, 20% of the total global oil supply is suddenly trapped. It also cuts off 20% of all liquefied natural gas, or LNG, and up to 30% of the world's fertilizers. What started as a targeted military operation triggered a massive global supply chain freeze, and it is exactly the kind of macroeconomic shock that Wall Street fears most. This chart tracks the price of Brent crude oil. You can see how the market reacted to the news of the strikes. Prices spiked violently from a baseline of $67 a barrel straight toward the $120 mark. The panic quickly bled into U.S. equities. At the opening bell on Monday morning, the Dow Jones Industrial Average plunged roughly 600 points. The real fear driving that sell-off is an economic condition called stagflation. Stagflation is a worst-case scenario where skyrocketing consumer prices collide with a slowing, stagnant economy. There is a direct mathematical link between the cost of crude oil and the wallet of the American consumer. Data shows that every 10% increase in energy prices pushes global inflation up by an additional 0.4 percentage points. That directly suffocates everyday purchasing power. Because consumer spending drives 70% of the total U.S. gross domestic product, or GDP, the standard measure of a country's overall economic output, this targeted energy inflation acts as a direct assault on the main engine of the American economy. The damage is not contained to the U.S. 80% of the crude oil passing through the strait is destined for Asian markets. Cutting off that supply cripples the manufacturing sectors of major economies like Japan and South Korea, who rely heavily on those imports to function. Back in Washington, this creates an impossible dilemma for the U.S. Federal Reserve. They are trapped. If they cut interest rates to stimulate the slowing economy, they risk pouring gasoline on exploding inflation. But if they hold rates high to fight inflation, they risk crushing economic growth entirely. The internal panic over this exact scenario reached the highest levels of the U.S. Treasury Department. Treasury Secretary Scott Bessent floated a desperate contingency plan on live television. He suggested the U.S. might unsanction millions of barrels of Iranian oil currently stored on offshore vessels, allowing it to enter the open market, just to bring prices down. The United States government is so terrified of a domestic stagflation cycle that it is openly considering rolling back its own geopolitical sanctions to protect the dollar. But as the trading day progressed, the market did something entirely unexpected. Despite the terrifying morning headlines and the initial 600-point crash, the major indices completely erased their losses by the afternoon. The Nasdaq actually closed the day higher. This table of historical sell-offs illustrates the adage, buy at the sound of cannons, sell at the sound of trumpets. After Pearl Harbor's 10% drop, markets recovered 15% 12 months later. The Gulf War and 9/11 show identical 6 to 12-month market rebounds. There is one massive caveat to this trading strategy. This historical precedent only holds true if the supply chain disruption, in this case the closure of the Strait of Hormuz, doesn't become a prolonged or permanent feature of the global economy. While retail investors panic and sell based on breaking news headlines, institutional wealth is busy buying the dip, betting heavily on historical data and the inevitable resumption of global trade. This chart shows two potential paths forward. If diplomatic efforts succeed, oil prices are projected to retreat below $95 a barrel. But if hostilities drag out, we're looking at a surge toward $150. The short-term fate of the US dollar and the severity of inflation at home rests entirely on which of those two paths materializes in the Middle East. Building wealth in this environment requires mapping the invisible threads between geopolitics, commodities, and the dollar, a strategy that means looking past the immediate noise of the headlines. To continue uncovering the hidden power dynamics behind the global economy, hit the like button and subscribe to Dollar Logic USA.